Okay, so thank you everyone for being here. This is the second conference within our ciclo de conferencias that the Ramón Areces Foundation sponsors in collaboration with the Cátedra UAM Auditores Madrid of Autónoma of Madrid University. So we are very happy to be able to be here today and also to have such an outstanding speaker. But of course, for us, the support that the foundation provides is fundamental. And I see a lot of familiar faces in the audience, people who've been participating in many of these events for years. So this is, in fact, the 11th time that we're hosting this ciclo de conferencias. And this year, we're really delighted to have with us Katherine Schipper, who is currently professor at Duke University, but in her past, she has been at the University of Chicago and also has had many editorial positions, including being the editor of Journal of Accounting Research. She has numerous publications in all the journals that are aspirational for many of us, and she keeps getting these publications out systematically. She was the first woman in the Hall of Fame of the AAA, and being a woman here is not something to be remarked upon, because her merit, of course, is being in the Hall of Fame by her own merit. But I should say that she's also been named American Accounting Association Outstanding Educator, Distinguished International Lecturer. So she's a person that has not only done a lot of research, but also has had very successful career as an educator, and she was also a board member of the FASB. So also being part of very important positions in places where she could influence and transfer the knowledge that we create, not only in her own work, but as academics. So for us, it really is a great honor to have here Katherine with us. She's been an inspirational figure for many of us. And today she's going to talk about, I think, one theme that is perhaps at the center of many controversial issues currently as well, which is materiality in financial reporting and auditing. So I hope that this will be interesting for all of you. I will stop talking now. I will let Katherine take the floor. The idea is she talks uninterrupted for around 40 minutes, and then we can have questions for her. So thank you, everyone, for being here, and thank you, Katherine. The floor is yours.
My thanks to Bea for giving me the invitation to speak here, and my thanks to the Foundation for this opportunity and all of their support for accountancy. And my thanks to all of you for coming out this evening in the rain to listen to an accountant talk about materiality. There's a cautionary statement at the bottom of the slide that says that what you're seeing here is my subjective analysis. It's based in part on my co-authored research, in part on some other sources. Others who were considering this topic might take a different perspective, use different sources, and make different comments. The presentation is not here to review research, it's not here to criticize, and it's not here to praise. It's largely descriptive. My starting point and the topics considered are on this slide. The starting point takes the perspective that materiality is foundational, it's pervasive, it's essential in financial reporting and in assurance. It has two functions, one of which I think receives considerably more attention than the other. The first function is what I'll call the inclusion and preparation function. Materiality specifies that decision-relevant information is to be included and to be prepared consistent with authoritative guidance. So it's an inclusion and preparation criterion. And although most people think of materiality as applied to reported amounts, it really does encompass presentation, classification, and disclosures. Footnotes. We think that preparers and auditors are probably using similar guidance and similar principles, but I don't think we know that for sure. I'm going to take that as given in this presentation, and that presumption may be incorrect. What I think is less considered is what I'll call the exclusion function of materiality, that is intended to reduce or eliminate the presentation of distracting and non-decision relevant information in financial reports. If the exclusion function of materiality is working properly, it will reduce preparation and assurance costs. So that's the cost of making the financial statements and getting assurance, and it will also reduce financial statement users' information processing costs. But we don't know much about whether that function is being properly carried out by materiality. I will say in my own jurisdiction, the United States, it is almost surely not being carried out because of the asymmetric loss function facing financial statement preparers and auditors. They can be punished if they don't meet the inclusion criterion, but just putting in useless information doesn't tend to result in any financial penalty. It just confuses people. The topics I'm going to consider are listed at the bottom of this slide. I'm going to talk about materiality as it's defined and discussed by financial reporting standard setters, the IASB, the FASB, materiality as an amount based on guidance and entity-specific facts and circumstances, and then I'm going to talk about attributes and consequences of materiality assessments, and that's a lot of my own research. This is the IASB's 2018 definition of materiality. And you can read this just as easily as I can, and of course, I hope you already have read it several times. But I want to draw your attention to the use of the word obscuring. Obscuring is a word that encompasses an unclear presentation or an unclear expression of something. And in English, it carries with it a connotation of concealment. If you obscure something, you make it hard to understand. And I have no idea how to make that operational. But the definition says, leaving it out, that's omitting, misstating, that means the incorrect amount, or making it hard to understand is a problem in the IASB's definition. This definition is, of course, distinct from legal constructs, which tend to be jurisdiction-specific, and one that is commonly referred to as the U.S. Supreme Court's decision. It also changes the definition from the IASB's perspective because the criterion used to be could influence decisions, and now it's could reasonably be expected to influence decisions, which is a judgment. And of course, it emphasizes that materiality is entity-specific and context-specific, cannot be specified ex ante, and is always related to a particular situation. The FASB's definition, also revised in 2018, is similar, not identical. It doesn't refer to obscuring, which I think is an interesting choice. So apparently, in US GAAP, we don't care if the information isn't clearly expressed or it's hard to understand. But I do believe that that notion of obscuring information, that is unclear communication, is one that is meritorious and worth considering from a teaching and a research perspective. This way of viewing materiality also uses the word probable, which is defined in IFRS as more likely than not, but interestingly enough, the word probable is not defined in US GAAP. The notion of what is probable is left up to the subjective expert judgment of preparers and auditors. It does clarify this definition, as does the IASB's, that magnitude alone is not sufficient for judging materiality, that it is entity and context specific. And this brings me to the notion of legal constructs, and specifically Securities regulation. Now, I could do an entire presentation, and so could you, about the way securities regulators around the world interpret materiality. But I just picked one by Paul Munter, who's now not the acting chief accountant. He is the chief accountant of the US SEC. And I want to draw attention to 4 things he said in this particular document. The first one is that magnitude and contextual factors appear to operate in one direction only. That is, contextual factors can make a small magnitude amount material, but it's much harder to argue that they make a big magnitude amount immaterial, which suggests to me that magnitudes could be dispositive. That a very large error or omission is almost surely material regardless of the context in which it occurs. But a small one could also be material because of the context in which it occurs. And he points to 3 arguments that he says the SEC staff does not find persuasive. So these are non-persuasive arguments. The first one is the argument that an item can't be material if it doesn't provide decision-useful information. That's the irrelevance argument. I didn't provide this information. It might have been material, but it's decision irrelevant. Now, I interpret that as being substantially deferential to financial reporting standard setters, because the implication is if the guidance says you should provide this information, you should provide this information. Even if you think nobody uses it, it's not decision relevant. So it's deferential to in the United States, the FASB. It's not up to the preparer or the auditor to label something as not decision useful. If the guidance calls for it, put it in there. The second one is reporting errors. We have this concept in US GAAP called diversity in practice. And it's a problem, or else it's just an exploration of alternatives. But it has to do with how practice interprets and implements a given standard. And there are some well-known examples in the United States where a very substantial number, up to several hundred SEC registrants were required to restate their financial statements for a single interpretation of US GAAP. The example that comes to mind most easily is an interpretation of the now superseded leasing standard. Well, what the chief accountant of the US SEC says is there's no safety in numbers. If there were 2 people or 2 registrants making this error, okay, that's fine. If there were 200, it doesn't make it any less serious. So widespread misapplication in the minds of the SEC is no excuse. And the third one is this netting or offsetting argument, where I certainly have been in a situation where it was explained to me, I'm using the passive voice here very carefully, that the errors taken in context were 0 net. And of course, the SEC would say, well, you can't do that. An error is an error. Offsetting it with something else doesn't make it not an error. Now, those, of course, are interesting perspectives, and others may disagree. That's a perspective of the securities regulator who's interpreting the guidance on materiality. Well, let's talk about these judgments. We know they're important, but we can't see them very often. We can see the outcomes of judgments, what's in the financial statements, what might be omitted, but we can't see the judgments. We see the results. In the UK and in Ireland, there were certain listed firms there's an auditor requirement to provide the materiality amount since 2013. But that's not everyone in the UK and Ireland, and it certainly doesn't apply in other jurisdictions. So there's some research using these jurisdiction-specific materiality judgments, and it provides some descriptive statements. In the United States, we have an auditor regulator, which is called the Company Accounting Oversight Board, even though it regulates auditing. but it's the regulator of the auditors of SEC registrants. And as part of its function, it collects auditor materiality amounts, along with a lot of other information, as part of its inspections of audits to make sure that auditors are properly applying authoritative guidance. It doesn't make these amounts publicly available, but it does make them available to researchers who submit approved research proposals. And two of the papers that I'll be talking about use PCAOB data. These are not publicly available, but they are available subject to non-disclosure agreements to approved research projects. Management almost never states its materiality amount. Once in a while you see it in a response to an SEC comment letter, but because of the extensive rules around how errors are corrected in the United States, it is sometimes possible to infer the materiality judgment. I'll explain that on the next slide. During the rest of this presentation, I'm going to discuss 4 questions. What factors determine materiality judgments? Are they consequential? Do they mean something? Are there discernible benefits if preparers correct all errors found by the auditor, even those that are deemed immaterial? And given existing materiality definitions, should immaterial errors convey no information whatsoever? We go back to the definition of materiality, and one implication might be, if it's immaterial, it can't possibly affect anybody's decision. This chart shows the rules for immaterial error corrections in the United States, and they're extensive because that's what we do. We have a lot of rules. Now, this is all since 2008, and it tells a person who's reading an error correction something about management's judgment about the materiality of the error. So on the one hand, if the error is deemed to be material to the financial statements containing the error, and our research identified 634 observations, it must be corrected by restating the affected financial statements, and Form 8K, which is a required form, must be filed with a statement of don't rely on those previously issued financial statements, a statement of non-reliance. That's the most serious one. However, there are other errors which are deemed not material to the financial statements that are affected. However, in the United States, those have to be corrected anyway. So it is not permitted, I'm going to say a double negative, it's not permitted not to correct immaterial errors. But there are 2 ways to correct them. If the error is immaterial to the financial statements that are affected, it might be material to the current period financial statements. So, got to revise. Those are called little r restatements, and they involve revising prior period comparatives and putting the correction through retained earnings. The most minor errors are corrected by an out-of-period adjustment. Those are deemed immaterial to the affected statements, and they're deemed immaterial in the current period. And those, we have 1,272 of those. So you can see from this chart that the most numerous in our sample is the little r revisions, which are not material to the affected period, but would be material if you corrected them in the current period. What do these things look like over time? Well, in this chart, the really heavy black line shows the percent of registrant filings that had material error corrections. It goes up around the early period of implementing the Sarbanes-Oxley Act, and then it starts declining. And it declines pretty substantially. What goes up? Immaterial errors. Now, there are 2 ways to interpret a chart like this. Interpretation 1 is things are getting better because we have higher quality financial reporting. Yes, there are errors, but they tend to be immaterial. The other possibility, which is not so optimistic, is that management is reluctant to designate a detected error as material to the financial statements containing the error, and they push hard to keep that from happening. Now, what's the resistance that they would meet? Well, it would be the auditor on the one hand, and of course, the SEC staff, the Division of Corporation Finance, could take a look at that filing and ask for more information. So things are either getting better or they're not using this information. This paper by Chowdhury et al. Asks whether immaterial errors contain information. Going back to the definition of materiality, it turns on whether the judgment of a reasonable investor would be affected. And one way to ask, well, was the judgment affected, is to do what academics call an event study, which is a test of the share price response to the error correction. And this chart shows the heavy dark line shows the share price response distribution at announcements of a material error correction. And as you can see, the mean is negative. It's about 3.3%. But you'll notice that there's a big right tail where not only is the response to a material error correction not negative, it's positive. Sitting on top of that, the grayish lines are immaterial error corrections. And there, the means are all negative, but the amounts are much smaller. So the equity investor share price response to being notified of a material error is, okay, revise the stock price down about 3% on average, but there's a lot of dispersion. And immaterial errors, not so much of a response. Now, the paper that we published it's an academic paper, so it's got 10 tables and a lot of details, but the message here is there's overlap. These two distributions are not distinct. The share price responses to the immaterial errors overlap with the investor responses to the material ones. So what are investors potentially learning? And what we conclude in our paper that they're learning about unreliability, because errors in financial reporting are unreliability. So we use immaterial errors, which include both revisions and out-of-period adjustments and restatements, and we predict, could you have a material restatement the next period or 2 periods later? And the answer is, well, yeah, maybe you could. Now, during our sample period, which is 2004 to 2015, the unconditional mean restatement frequency is between 3 and 4%. So this says that it's not a disaster if you have immaterial errors, but it's not good either, because it indicates that there's an increased association with the really bad stuff, which is the restatements. And then in the second lower panel, there's definitely a recurrence of immaterial errors. We conclude that immaterial errors tell you something about financial statement unreliability. It tells you that there are errors lurking in your financial reports. And you could, of course, use this information to say, well, we ought to take a look at our reporting systems. Now, our other measures of information involve 2 other things. One of them is a finding of a material weakness in internal controls over financial reporting, which is a thing in the Sarbanes-Oxley Act that both management and the auditor have to give an opinion on. And we see here that immaterial errors are associated with future judgments of material weaknesses in internal controls. Now, is that consequential? Well, yes, it is, because a registrant that has material weaknesses in internal controls, the auditor has to extend audit procedures, which raises the cost of the audit. And we saw in the previous slide that, yep, those errors persist. Another cost is you may get a letter from the SEC, Division of Corporation Finance, which is not good news, because it's a letter that says, we question what you're doing in your financial reporting, and we want you to write back to us and explain. And if we don't like the explanation, we're going to go to the next level. So what do we conclude from this? We conclude that looking 1 period ahead or 2 periods ahead, these immaterial errors tell people something about the financial reporting system's reliability. So what do we conclude from our response? Well, First of all, immaterial errors and material errors are not that distinct. They overlap, for sure. The distributions of their magnitudes, which I didn't show, and the distributions of the share price responses, they definitely overlap, which tells me, and I hope it tells you, that these qualitative and contextual factors are extremely important in determining materiality. We also think that immaterial errors are diagnostic. And in our paper, and whenever I speak about this, we say audit committees and others should take a look at immaterial errors because they tell you where there's a problem. The fact that it's not material doesn't mean it's not diagnostic. And of course, for researchers, we think that these three categories of restatement, revision, and out-of-period adjustment are nuanced measures of reporting quality. The next paper I want to talk about is descriptive evidence on auditors' quantitative materiality judgments. Now, I mentioned that there's research in the UK starting with data in 2013. This is US data, and it comes from our access to proprietary PCAOB data from their inspections, 2004 to 2015. So we have quite a number of audits here, and these are the inspected audits. And we use these data to provide empirical evidence on three questions. Do auditors set materiality by applying some convenient rule of thumb, like 5% of net income? Now, if you think back to what Paul Munter was saying in that speech, or in that paper I quoted from, he says, be careful. Look at these contextual factors, because they can make a small number material. Then, of course, we know that materiality assessments vary. What explains the variation? And what's more important, auditor judgment or client characteristics? This next slide shows in the blue bars, for our sample, materiality expressed as a percent of pre-tax income. Now, I want to emphasize a couple of things. The first one is that right-hand side goes out to 15%. However, there are 687 observations in our sample where quantitative materiality divided by net income exceeds 15%. Those, of course, would be situations where the reported income is pretty close to zero, so it's a small denominator issue. Many of those observations don't use pre-tax income as a base. They use something else. Revenues are common. EBITDA is surprisingly common, and so are assets. Furthermore, we express materiality as a percent of income, but that doesn't mean the auditor calculated it that way. Auditors have the right and the obligation to use a number of bases. We agree in our paper that the most common materiality base is pre-tax income, not net income, pre-tax income. It's used by about 59% of our observations, and the second most popular is revenues, about 17% of our observations. Now, the white bars are what happens when we eliminate any entity that reported a loss. Loss incidence among SEC registrants in our sample period is about 25%. So about 25% of the time, SEC registrants are reporting a loss. And you can see the distributions are similar, but they're not identical. And we do have those 687 extreme observations. I don't report any results for UK firms, but published research suggests they're similar, not identical. We have measures of auditors' quantitative materiality judgments. That is, we have the number. And we are therefore able to regress this number on logical bases to use: pre-tax income, revenues, and assets. When we do this regression in levels, those three size measures explain about 90% of the variation in materiality judgments, and no one client size-related factor subsumes the others. They all matter. So income matters, revenue matters, expenses matter. We then go to Staff Accounting Bulletin 99, which was issued, interestingly enough, in 1999, that lays out qualitative factors that should be considered in setting materiality. And we consider 4 of them. Break even means that the reported income is close to 0. It could be a small loss, it could be small profits, but it's close to 0. Loss means the entity reported a loss. Earnings volatility is a measure of how much the earnings goes up and down. It's a standard deviation. And positive streak is a 0-1 indicator that indicates whether income has been increasing year over year for at least 3 years. And we can see that these qualitative factors interact with the bases in predictable ways. For example, if we take a look at just losses, when losses are reported by the entity, you can see there's more weight placed on assets in calculating quantitative materiality, which suggests losses are special in setting materiality. We can also see that assets are less considered when there's been an increase in earnings. So these provide some insights into 2 things. The first one is that it is not true that, in our data, that auditors reflexively set quantitative materiality at 5% of net income. It does appear that they consider at least 3 bases, and they take account of contextual factors suggested by SAB 99. In our paper, we contribute by saying, okay, the size of the entity matters, but let's try to get a measure that isn't based on size. So we create a relative measure of auditor judgment so it's relative, that is not determined by client size. And we do this through a complicated algorithm, which is explained in the paper, that locates each and every sample materiality amount within a normal range. And the normal range is determined by the 7 bases that are listed in Eilifson and Messier, which is a very influential paper because they got access to audit firm manuals and they copied information out of it. Very useful to us other researchers. And we also know the percentages applied by every auditor in our sample. So we combine them all together, and we use the 5th and the 95th percentiles, take the tails off, and we calculate every possible base times these materiality percentages, drop the most extreme, and then locate the actual materiality amount in the distribution of normal amounts, which are, again, set by applying percentages times 7 bases. And I'm going to show you what that looks like in a minute. This measure is still correlated with size, but it's only 10% correlated with size. And it's 25% correlated with unadjusted amounts. And what is important for our purposes, it appears to be associated with the conduct of the audit. The looser the materiality, that is, the more generous it is within the normal range, lower audit hours, lower audit fees, which sounds like, okay, planning materiality is used to set the audit. This is what the sample distribution of materiality looseness looks like. Now, these are not deciles. These are 10 equal-sized ranges. And on the very end, we see this 0.3% of the sample, very conservative. It's outside the normal range on the low end, very strict. Going all the way to the top, 2.2% are outside the normal range on the generous side. But most auditor materiality amounts are in the left-hand side. So they're pretty strict, they're pretty conservative. And of course, the empirical question is, well, what about those ones out there in D8 and D9 and D10? Are they consequential? We're not worried about the ones on the left. We're wondering about the ones on the right. So we do some extensive analysis of this, and we ask ourselves, well, does this matter? Now, of course, the reliability, which we measure as 2 ways, the magnitude of auditor-detected adjustments, so they're not signed, they're magnitudes, and also the incidence of restatements. And we have a null hypothesis prediction, which is if this materiality is set appropriately, which is another way of saying if all of those judgments reflect the objective and expert application of authoritative guidance in context, then we have a good materiality amount, and the next thing is, well, does the auditor then appropriately execute the audit plan for that materiality amount, and the client makes the correct disposition decision? Then we'd see no association. But if anything breaks down in that system, we're going to get bad outcomes. What we find here is that the extreme materiality looseness, that's in D9 and D10 out there on the right, that is associated with fewer auditor-detected adjustments, which is consistent with lower audit hours. But that means lower magnitudes of proposed adjustments and a 6% higher likelihood of restatement. So these are consequential. These are consequential. What we don't know, of course, is whether those extremely loose, we call them loose, not strict, materiality judgments just reflect a rational cost-benefit trade-off, or they reflect some kind of breakdown in professional judgment, or some other possibility. We just don't know. So what do we conclude from this? Well, from this descriptive evidence, we conclude that those who are suspicious of the way auditors set materiality should feel some assurance that auditors are using contextual factors to set materiality. These materiality judgments have predictable associations with audit inputs and audit outputs. More permissive auditor materiality assessments are less frequent than strict assessments. So it's, in our sample, it's not true that the auditors are way out here in the right-hand side of the possible normal range. What we don't know, of course, is whether those looser auditor materiality amounts are somehow causally linked to bad audit outcomes, and if so, why? Why do they happen and how are they linked? And what we don't know is how auditors make the complicated trade-off of setting materiality relatively strictly, more audit hours, higher audit fees, or relatively loosely. And this brings me to the last thing I want to talk about, which is waiving audit adjustments. We use PCAOB data again, different data. And we now have data on what management does with the audit adjustments. Do they record the adjustments? Do they waive the adjustments? What happens? Well, in our data, we find that about 4/5, 80% of all the audits in our sample have at least one proposed adjustment, which means 20% don't. Now, either those are the really, really good quality financial reporting firms, or that's the ones where the auditors set materiality too loosely. 74 and 75% have something on the income statement, something on the balance sheet. Many of these have multiple adjustments. So these things, you can have 2 income statement and 2 balance sheet adjustments, multiple ones. What we found most interesting is about half the sample, management doesn't record anything. They waive all the proposed adjustments. And in about 12%, they record all the proposed adjustments. So if you went into, we did go into this paper thinking, oh, they probably record some and waive some. That's actually not descriptive. About half the time, they don't record anything. About 12% of the time, they record everything. And we have 22 observations, which is 0.7% of the sample, where waived net income adjustments exceed quantitative materiality. 22 observations. We find that these waived adjustments are, I'm going to put it this way, proposed adjustments, which are errors that the auditor detected and suggested management correct, these are positively related to restatement incidents. In other words, when the auditor finds a lot of errors and big errors, restatements are more likely. However, if management records those adjustments, then it seems to help financial reporting reliability. So the advice there is, if the auditor says, I found an error, then record it. Waived adjustments are positively related to restatement incidents, especially when they get bigger. And they are particularly strongly related to restatements for the 0.7% of the sample, 22 observations, where management waived income adjustments that exceed quantitative materiality. Now, we did every kind of analysis we could think of to try to find out whether the adjustment management waived was subsequently restated, which is actually harder to do than you might think. And I'm very careful here to say that we found some evidence of overlap, that when management waives a net income adjustment, it can come back later and require a restatement. We also explored, to the extent we could, whether this is a very popular idea among academics, that management waives audit adjustments to manage earnings. Okay. So we said, let's take the loss avoidance view, which means that this adjustment would be big enough to turn what might have been a loss into income. And I won't go into all the assumptions and calculations we had to make to do this. But we come up with some notion, I don't want to lean too hard on this, that larger, above the median, waived net income adjustments are circumstantially associated with loss avoidance. Circumstantially associated with loss avoidance. Now, we also did a variety of other tests on audit committee characteristics and client characteristics and management characteristics, and we, like other research teams, found almost nothing except one encouraging sign. If the audit committee contains an audit committee, a financial reporting expert as defined by the Sarbanes-Oxley Act, there is less likely to be a large waived adjustment. I find that encouraging. We also ask ourselves whether the auditor responds to large waived adjustments in the next period. For example, does it quit? Well, the answer is no, because, well, first of all, let me be honest. Auditor turnover among U.S. SEC registrants is very low. And in our sample, it's 3.1%. There's not much going on there. We don't think that we have very compelling results. We do, however, note that larger waived adjustments are associated with future audits. They're associated with more hours and more fees, which suggests some degree of auditor response. And I want to draw your attention to one intriguing result. Waived, for 22 observations in which the waived net income adjustments exceeds quantitative materiality, there's a big increase in next period's audit fee. But there's not a big increase in next period's audit hours. This suggests that the auditor isn't working more, but the auditor is charging more. And that 17.9% is actually a material adjustment in the audit fee. It's suggestive, it's not dispositive, but it kind of points in the direction of price protection. So I've got a couple of sets of concluding observations here, and these are, of course, idiosyncratic to me. Materiality is supposed to operate to distinguish decision-relevant items from items that don't need to be reported. The IASB, FASB, and legal definitions are similar, but they're not identical. I believe that these differences have unknown implications for reporting, especially that obscuring business in IFRS. In most jurisdictions, we can't see the materiality judgments, so the available academic evidence comes from experiments, from the few jurisdictions that provide materiality information or proprietary sources. And most research, as a result of data constraints, doesn't ask whether materiality is effective in excluding immaterial information. It's more whether it's effective in including material, decision-relevant information. What does archival research suggest? First of all, auditor materiality assessments are complex, and they probably reflect a substantial amount of professional judgment around contextual factors. That said, if you believe our measure of auditor loose materiality, that's a danger zone. It may reflect a perfectly rational cost-benefit trade-off, but it leads to higher incidence of restatements. And we also think that we provide persuasive results that even immaterial errors can be consequential because they're indications of future reporting unreliability. Thank you very much for this opportunity to speak with you this evening. As Bea told you, you have an opportunity to ask a question or make a comment, and that, of course, that choice is entirely up to you. Thank you.
Thank you very much for coming to Madrid. It was very nice having you here and hearing your speech. I would like to ask, in the start you talked about the differences, also in the concluding remarks, about the differences of the definitions of the FASB and the IASB, about the obscurity, right? So, in your opinion, or you already said that we do not know, but in your opinion, do you think that having this word obscuring in the European, in the international standards, makes European auditors more strict, more cautious? And another related question about immaterial errors. You showed that through the last years, in the last 2 decades, in the US, we had this increase in immaterial errors. Is there research about immaterial errors in Europe? Is the same trend in Europe, or it does not exist? Thank you very much.
Thank you for those 2 questions. I'm going to take the second one first. It is very difficult to study immaterial error corrections outside the United States. And for many years, it was difficult to study them inside the United States because there was a general belief in the profession that immaterial errors, once detected, didn't need to be corrected. They're immaterial. We don't care. And this led to a certain, I'm going to call it, buildup on the balance sheet of immaterial errors. So the SEC issued SAB 108 that said, when you detect an error, whether that error is not material, whether that error is immaterial to the statements that were affected, doesn't matter, you must correct it. I am not aware of another jurisdiction that has these fine distinctions between material error, immaterial corrected by revision, immaterial corrected by out-of-period adjustment. There may be another jurisdiction, but I have not encountered it. So therefore, I can't say. Now, what about this obscuring business? I think that that's an intriguing idea because it has to do with making it hard to process the information. Now, there's some American academics who are making a name for themselves talking about information that's hard to process and coming up with measures of hard to process information. And I think those measures are dangerous. Let's take me, and let's take a randomly occurring master's student, one of you, and let's give us both a set of detailed financial statements, including somebody who's got a lot of use of derivatives to hedge forecasted cash flow transactions, and very complicated instruments that are hard to classify as liability and equity. And I don't know, let's throw in a goodwill impairment. It might be hard for me to understand that information, but I'm going to get there. But the master's student who hasn't read 17,000 Form 10K and Form 20F may have a more difficult time. So this obscuring business requires a benchmark, doesn't it? And that's why it's intriguing. Academic research is supposed to be able to bring to bear analytical firepower to shed light on the terms and concepts used in financial reporting and assurance. And I think that that's an interesting term. Intriguing. Intriguing. Thank you for those questions.
I was wondering, with the 2018 changes to the definitions of materiality, both in the FASB and EASB, and I was wondering what the objectives of the standard setters, what the objectives are, what is it they want to change, and whether we might expect any effect on the actual materiality thresholds that are being used, or if these changes in the definitions are just aimed towards the very same standard setter to influence other standards, or why these adjustments that I don't know, the relatively small ones that periodically we see, and whether in this specific case you foresee any changes to anything that are coming from this.
I'm going to try to say what you asked me, and I might get it wrong. Are you asking why these two standard setting organizations change these definitions?
Yes.
Okay. By way of history, sometime in the 2000s, this is back in the days of what was called convergence, and the IASB and FASB were going to converge and complete their conceptual frameworks. So they changed both conceptual frameworks to bring them closer together. Time passed, and the IASB said, we no longer agree with that, we're going to change our conceptual framework. And the FASB said, well, then we will too. You know, it's not necessarily a good idea, but it reflects, first of all, a change in who was the chair of the IASB and his views about concepts. And it also reflected a good deal of discussion and ferment on the notion of what is called in the United States disclosure overload, which is believed to be the insertion of massive amounts of useless, decision-useless information into the financial reports. So there was this idea that by clarifying materiality, it would induce preparers and auditors to prune down and remove irrelevant information from the footnotes. It has not had that effect. It may have had the opposite effect. I cannot explain where the notion of obscuring came from. I don't know. But I can say that it's got to be in there for a reason. And the reason, I believe, has to do with clarity and simplicity of communication. As to the broader question of why standard setters change their conceptual frameworks, usually they change them because they found something that isn't working right, or they believe it isn't working right. They could be wrong about this, of course. And I acknowledge that that's not a satisfactory answer to your question. It's the best I can do.
Hello, good evening. Thank you very much for your presentation. I just have one question. From your presentation, I think you highlighted how relevant enforcement is in financial reporting and auditing, and the significant role that the SEC and the PCAOB play in the United States. You also mentioned the fact that it's much more difficult to find the information about the adjustments and also the information about the inspections outside of the US. And you really gave us a very broad overview of the concept of materiality. I'm just wondering how, under the new concept of the double materiality, under the broad spectrum of the ESG reporting, how companies and insurance companies, how auditors and companies, preparers and auditors will be able to face this broad concept of materiality under the spectrum of the ESG information. And particularly in a context where still the enforcement mechanisms are not so do not have the strength that the ECC or the PCAOB have developed along the years. So thank you.
Thank you for that question. I was deeply hoping somebody would ask me that because I want to give you my opinion on that use of the term materiality. So we know what materiality means in financial reporting and assurance, and we've worked with that idea for a long time. And another group took the word materiality and assigned it a different meaning without changing the word. Because this other use of the word materiality actually reflects an externality. It's an unpriced impact on the environment. It might be positive, it might be negative. In most people's minds, it's negative. And the concept of an externality is that it is a benefit or a cost imposed without the recipients paying anything or receiving anything and without that person's consent. So if I'm running a chemical plant and I dump my chemicals into the river, it's a negative externality. If I am operating my chemical plant and I add many new jobs and people move to the area and the area prospers, that's a positive externality. Okay. That actually doesn't have anything to do with materiality in financial reporting. It's an important concept. It matters deeply if you're thinking about inducing profit-seeking and not profit-seeking entities to internalize their externalities. It matters greatly, the mechanism for inducing that. But I think that to cause it double materiality, like it's two sides of the same thing, I don't agree. I think that it is better to use terminology which is descriptive of the thing you want to have happen. But that's one person's opinion. And I think that the term that is descriptive is externality. But thank you for that. By the way, when we're talking about financial accounting, it has a very powerful feature, and that is everything trues up. Liabilities either default or get paid. Assets settle one way or the other, or they run out of service life, or they get impaired to zero, but something happens. But in the kind of area you're talking about, I don't know how you provide assurance except over the process. How could you provide assurance on the amounts? There's no number to true it to. So that's another reason I have a problem with that concept. I think there's ample scope for thoughtful analyses of these things by people who have spent their careers contemplating financial reporting, and I hope that more of them get involved. Thank you for that question. I am cognizant that this is supposed to end now. Is that correct? So if there is one more question, I could take one more, and if there's not one more, then we'll end now. Okay, I'm going to say there's not one more, and I'm going to thank you so much for this opportunity. I really appreciate it. Thank you.